Hi everyone, welcome to Get Wang a Limo Hedge Fund. Meet the team, San Chu, me, Kevin Zhou, Zhiyang and Sakura. So our agenda today, we're going to talk about core ideas, strategies, derivative usage, fund performance, and reflections. So start with core ideas, explaining our main ideas and our motivations behind them. So the core idea encapsulating our hedge fund was trying to construct a diversified portfolio comprised of 60% equities, 30% derivatives, and 10% bonds. By doing so, we felt safe taking on riskier bets in our derivative trades thanks to the safety net our bonds and equities provided. We chose this strategic blend of assets thanks to our short-term bearish outlook on the economy at the time, in which we believed the Fed would continue raising rates. At the time, we presumed our prediction to be correct because the market priced in a 50% chance of the Fed raising rates. Further, we didn't want our buying power to wither away from inflation, so investing a lot of cash we weren't likely to use anyways and safer investments seemed like the most logical step. This belief permeated throughout our equities portfolio, where we employed a top-down approach and invested predominantly in defensive stocks and ETFs. By selecting ETFs that are generally resilient during economic downturns, such as utilities and healthcare, our portfolio aims to mitigate the negative impacts of idiosyncratic risk and a potential economic recession, which we believed was an inevitable consequence of the rate climb. Meanwhile, when picking stocks, we employed fundamental analysis, choosing companies with strong economic moats and exemplary financials, such as Coca-Cola and Walmart. For our derivatives portfolio, we employed technical analysis and speculative predictions to hedge risk and make money. We believed that during the course of our project, that the market would face extreme volatility, and as a result, we hope to take advantage of short-term movements in either direction. Meanwhile, we utilize technical analysis to help time our orders and support our ideas in our speculative bets. Finally, our bond portfolio served as a counterbalance to our riskier equity and derivative components. Bonds provide a guaranteed source of income, and as a result, with interest rates being so high, we saw it as a way to make guaranteed returns.
Moving on to the implementation phase of our approach, we centered our efforts on three primary strategies: fundamental analysis, information trading, and technical analysis. In terms of fundamental analysis, we screened for quality companies with sustainable competitive advantages. We looked for growing companies with high PE and ROE ratios relative to industry averages, and we selected defensive companies given the short-term bearish outlook. Some examples of the stocks we bought are Coca-Cola, Verizon, and Walmart. Our following strategy revolves around information trading. By consistently analyzing relevant industry news, market trends, and events, we sought to anticipate potential impacts on various stocks. This proactive approach allowed us to make informed decisions, aligning our trades with expected market movements. An example of this is, upon hearing about the automotive industry workers on strike, we anticipated potential repercussions for Ford's reputation and short-term profitability. And in response, we initiated a bear put spread, aiming for a decline in prices from $13.5 to below $12.5. We also relied on technical analysis to predict short-term fluctuations in stock prices and used option combinations to strategically enter and exit positions at opportune moments. A stock that caught our attention was Apple, as on September 28th, we saw the price break through an important resistance level that was established previously on August 18th. Taking a closer look, we found that the 5, 10, 20, 30, and 60-day moving averages have downward trends, suggesting a bearish outlook for Apple. Now, looking at some indicators, we saw that ADX is below 50, suggesting that Apple's downward price swing has not reached a minimum just yet. However, we saw that the KDJ lines converged upward, indicating a bullish outlook for Apple. So with both bearish and bullish indications, we decided to take a long straddle position for Apple, hoping for the price to swing in either direction. We carefully monitored this trade and saw a trade signal on October 16th when the KDJ lines began to converge downward, suggesting a bearish trend that will follow. Consequently, we decided to sell our call option to secure profits. We saw another trade signal on October 27th when the KDJ lines began to converge upwards again, suggesting a future bullish trend. On top of this, the ADX also rose to 50, indicating that Apple has reached a local extremum and a trend reversal will follow. Therefore, we sold our remaining put option to secure profits and finish this trade with an overall gain of 25%.
So here I'll go through how our hedge fund has used derivatives. One of the most common way we use derivatives in our fund is to hedge against the risk when we are holding the underlying. As an example, XLE, we concluded that the most direct impact of Israeli-Palestinian conflict was on the energy sector, where the shrinking supply could boost the oil price. Hence, we decided to enter a long position of XLE on the price of 87. However, due to slight lateness in response, our buying point was close to the resistance level 91. Hence, we long a protected put with a strike price 82 to hedge against the downside risk. The put can cap our losses from upcoming uncertainties in the international oil market. So, the energy sector did experience pullback due to abundant oil reserve in major economies, and it fell through the support level of 85. But we overestimated the volatility of such a sector ETF, and it didn't hit a strike in the end. Another way we utilize the derivatives frequently when trading our information and fundamental analysis was to avoid the risk of holding the underlying. For instance, in the case of BIP, we estimated fair value with DCF and find out the market value of them. We concluded that it was undervaluated by the market, and the strong earnings could give a bullish sign. But we still remain a bearish outlook for utility and infrastructure sector. Hence, by entering a long position in the call option, we can avoid the holding risk of our security with our maximized loss only the option premium. As we have assessed, the price started to go up after the earning release and eventually broke through the strike price. Hence, since we have higher expectation of fair value on this, we choose to not early exercise to fully capture time value, and we keep the stock on hand after the option expired, which provided us more than 8% gain combined. So, given our fixed allocation strategy, the high leverage nature of derivatives provides us optimal chances to realize high gains from market volatility that we predicted. In the middle of November, our analysis all showed that NVIDIA displayed bearish sign. Instead of directly shorting the asset, we try to avoid the unlimited risk borne, and a bearish spread become optimal for us. Hence, we decide to apply the bearish puts spread. In the meantime, we were also aware of the fact that the high leverage nature works both ways, so we intended to be very conservative in choosing strike price. We end up longing the put strike at 500 and shorting the put strike at 495. And the price of NVIDIA, as it turned out, experienced a huge drop after the earning release, and we managed to realize the maximum gain from the put spread. As our long put options go deep in the money in a few days, we chose to close the position early by selling it. However, due to neglecting the implied volatility, we set the short strike too high and miss out a large potential of return. So when implementing the above strategies, we did find out that money creates a strong initial debit, which can be extremely risky in terms of our asset allocation. Hence, we paid extra attention to balancing initial cash flow to maintain our designated cash balance. Predicting the both side volatilities in Apple by technicals and tracking informations, we applied a long straddle with strike price 175, as Sean has introduced earlier. And this move involved longing too close to being in the money options and could obviously be very risky in cash. We initiated a short strangle at 160 and 180 strike with much shorter expiration. So the price of Apple went down as we had predicted. But the tech giant was too big to fail in the short run, and our short options were not exercised anyway, which provided us strong remedies in cash balance. And there, we move on to introduce the fund performance overall.
Our final portfolio had a return of 3.23% and an alpha of 0.09. Our best performer was the NVIDIA put we exercised near the end of our trading days, earning us a total of 1.21 million. The trade was mainly based on a negative outlook on NVIDIA's November earnings report. Our worst performer was the Walmart equity we purchased near the middle of the challenge. On November 16th, Walmart had hugely disappointing quarterly earnings, and thus we lost around 1.05 million, with a holding period return of negative 89%. We took a top-down approach near the beginning and played safe to counteract recessional trends. Near the middle, we became more risk neutral, betting on mostly on earning plays like the Brooksfield Infrastructure Partners. At the end of our challenge, we decided to take a risk-seeking approach, hence the large NVIDIA trade. Our final portfolio ended up with 34.6% cash, 45.4% equities, 19.6% options, and 0.5% bonds because we sold stocks here and there to secure returns while holding on to stable ones such as our defensive sector ETFs like the Vanguard Healthcare and Utilities. Our next highest weighted sector is the retail trade sector, with stocks like Walmart. In terms of market cap, our portfolio contained only large cap stocks, which adversely impacts our risk return profile. Although we were well diverse across different sectors throughout the period, we lacked diversification in terms of market capitalization. Comparing our performance to appropriate benchmarks like the S&P 500 and the NASDAQ composite, we had a portfolio alpha of 0.09. And despite having 3.23 overall return in the period, our Sharpe ratio is fairly low at 0.64. This is likely due to us changing our risk preferences and conducting larger trades near the end, which increased overall portfolio standard deviation. Lastly, a noticeable trait from both our return graphs is a dip near the end, which is due to the high volatility of our large NVIDIA put order.
Our project focused heavily on diversification. We invested in a mix of bonds, major stocks like Apple, and options across various sectors. This approach showed us how diversification helps in reducing risks and tapping into growth opportunities in different markets. We took on high-risk options, leading to mixed results. A notable gain with NVIDIA, but a loss with Apple. We also learned the value of low-risk bonds in adding stability to our portfolio. A key takeaway was the importance of monitoring implied volatility in our trades. Our initial investment plan evolved over time, showing our adaptability to changing market conditions. We had to rebalance our portfolio in response to these changes. Significant losses in stocks like Apple and Walmart highlighted the risks associated with options trading. These losses were lessons in the impact on market volatility and the importance of staying informed about our investments. Ending with a high cash balance of 34.6% was a conservative move. It showed our caution, but also suggested that we might have missed taking more risks. We observed biases in our trading decisions. Loss aversion led us to quickly exit losing trades, where herd mentality influenced some of our choices, like following popular trends in buying options for stocks like Apple and Tesla. Thank you for listening. We are now taking any questions you have.